Welcome this week, everybody, to this week's Middle Class Investor. This is Seth Martin, your host, and we had a very strong week in the U.S. equity markets. We're currently looking at the S&P 500, and you can see that we had a follow through. This formation here is called a hammer, just like this one here, and you can see we followed through to the upside. Pretty strong, and probably going to be more upside here. It's the question we're always asking though is, are we going to have the upside immediately following this candle, or are we going to get some pullback first? Maybe to this trend line and then back up. So my call, or my guess, is that we get a pullback to this trend line first. A lot of times what happens is the market will break some level of resistance, some trend line, pull back and retest it, and then take off. We've talked about it before, but we've got this gap in this area around just under 2050, around 2045. And the market could easily pull back into that area and then rally up into this gap. In fact, if it might even pull back a little bit underneath this line and then resume to the upside. So look for something like that to happen. Maybe a little pullback and then a run up. It could be different than that, but that's kind of what I see at this point in the U.S. equity markets, S&P 500, Dow Jones Industrial Average, NASDAQ, Russell, and those type of accounts, those type of indexes. I'm going to go pretty fast tonight just because no particular reason, actually. I don't have a whole lot to say about the way the market's trading right now. I mean, I think this is likely going to be some sort of counter trend move in a downtrend market. And my recommendation, although I'm not here to make a recommendation, is that you pretty much operate under that scenario. The only thing that I a little unsure about is how long this counter trend rally is going to take. Usually, the downtrend started here, let's say on November 30th. So let's just call that December 1st. And now we're, 2/3 of the way through February. So what is that? That's January, February. That's basically 6 weeks. So the counter trend rally could last maybe 4 weeks. And so we've already had 2. So we likely have 2 more weeks of counter trend rally. I'd say 2 to 3 weeks. And we'll know pretty fast after that 2 to 3 week period whether or not this market's going to roll over and go down in a hurry. Some of you have been following the Fed interest rates. We drew this line here a while back. Several weeks ago, I said in this forum that the Fed was going to raise rates because these rates had broken above this resistance. You can see that rates pulled back a little bit, but then continue to go higher. And so the Fed will most likely be raising rates a number of times this year. Some people think that the Fed won't raise rates now because the market's gotten soft. I think the Fed is more concerned about its credibility than it is about the market, although I think it is concerned about the market. But if these interest rates go up, they've got to be seen as the reason. They really aren't up for letting the public know that they're not in control of these rates. So I think they will raise rates several times this year. You can see here that the 13-week Treasury yield is at 0.283 right now. That's a little bit greater than a quarter of a point. Of course, the Fed is at a quarter of a point, and I suspect these will continue to go higher, and the Fed will follow those rates right on up the ladder as they move. Since we're talking about rates, let's look at the 10-year Treasury. You can see that we had, basically a hammer type formation in the 10-year Treasury, although it didn't quite follow through. A follow through would have looked more like, a candle that closed up above this high right here. And of course, this candle didn't close above the high. It came down and it retested this channel line here, the upper side of this channel line. And so, again, we've seen that many times where that happens. Here it happened. The market broke out, came back, it retested the channel line, and then went higher. Same thing here. Touched the channel line, went higher, touched the channel line, went higher. And then here we are. We went through the channel line, but then closed at the channel line, pulling back a little bit. And I think you probably see these yields starting to move out here pretty quick. But we will wait and see. We'll defer to what the market actually shows us rather than trying to predict it, because that's difficult. Volatility came in, obviously. When the market goes up, volatility tends to go down. And you can see here that volatility crashed right through this trend line, but is still kind of operating or trading above this zone in here, which is kind of support, like a support area. So, I don't think volatility is going to get much lower than this area. Well, I don't know. It could drop back down into this range again. In fact, I'd say there's a 50-50 chance of that happening. So, volatility, though, the reason we want to watch it is because it tells us about the overall fear in the market. And certainly fear is greater than it was back here, but fear is still fairly low, and that usually bodes for some type of sell-off in the market. So we'll keep our eye out for that. Germany's market, all of these markets, we talked about it last week, they're all kind of moving together. Germany, Japan. It's interesting, Japan's interest rates went negative a few weeks ago. Their market kind of rallied. I think it was right in here where this hammer is. And then it kind of broke up and then just rolled right back over. So, and I think you're going to see more and more of that. You're going to see these central banks trying to prop these markets up, and they're just not going to be able to. The market is going to sell off regardless of what the central bank does. This is United Kingdom. United Kingdom kind of has come down in here into support. This area right in here, as marked by the blue box, is pretty strong support. So, we could get, in fact, we're already getting it, but we could get a bounce maybe as high as, that's not I wanted to draw a box, maybe into this zone right in here. So we might get a little pullback. Same kind of thing with the U.S. market, get a little pullback and then rally into this zone before rolling over and making some lower prices. Let's look at the Wilshire. The Wilshire looks, the best out of the U.S. markets. I don't know. The confusion for me is in this first down move here. This looked like, the trend change. And of course, the Wilshire is showing that. The point of confusion is in the S&P 500. You've got this first down move here, and the market rallied to a lower high, but then made a very similar move to this move, which in my mind is unusual. If this is the first move down and this is the correction, then this next move should have been much more dramatic, which tells me maybe this whole uptrend that started way back here in 2009, maybe it ended right here. Let me draw. Whoops, that's not what I wanted to do. Let me draw a little balloon right there. Maybe the uptrend ended right here, where that yellow dot is, and not back here. Even though this is a higher high, this could have been the last gasp run higher, and it was just truncated, like it didn't quite break to new highs. And this is our first move down. So it's, there's no way to really know which one is which. But let's operate under the assumption that this is the first move down, since this came down and rallied right here. Then what we would be looking for, if this, let me zoom in here. I realize this is a lot of kind of speculation, but I just want to kind of prepare you for some different scenarios. If this is the first move down, and we have some sort of counter trend rally that looks like this, and this counter trend rally represents the first move up after the first move down of this trend change, then this move will be very dramatic and swift. Again, I would have thought that would have happened here, but it didn't, which tells me that maybe this is the first move down and this is not. So it's a little bit of inside baseball. It doesn't really matter, but for my own personal, trading and things like that, I'm trying to better understand that, because this move in my mind should have been longer and wasn't. So I'm trying to find some explanation for why this move wasn't longer than it was. And it really, again, I said before, it really doesn't matter, but it's just for my own personal knowledge or education or however you want to think about it. Let's look at gold. Gold's rally, bull market rally, started way back here in 1999. We've had this huge run up in gold. Excuse me. And then for the last 3 years or so, gold has been falling pretty precipitously until very recently. And you've heard me talking about that. I thought anywhere around down in here was a good place to buy gold. Hopefully some of you did it. I actually bought physical silver. I think I actually bought it back over here. And of course I was rewarded, but then it pulled back, and I was kind of felt like I didn't do the right thing, but I'm not too worried about it now. Now, ultimately, you've heard me talk about this before. Ultimately, I think gold is going to go much lower, but you probably shouldn't wait until you can get gold lower, because you just might not be able to get it. So I think we're likely to see a rally here, and then maybe something like this, and then another big rally all the way up into this area. And then once we get back up into this 1500, 1550 area, then we're going to see a big sell-off. And I think what you're likely to see, and I know this is hard to believe, and some of you are not going to want to believe it, but I think we're likely to see gold down into this 650 area below this pivot. This pivot right here is an important pivot in this chart. And I think it will ultimately, it'll ultimately prove out to be an important pivot. So I've got this decision point drawn off this pivot here. And I think we'll see gold pull back into this mid 600 area. At least, maybe even slightly lower than that. Again, I know it's hard to believe, and some of you don't want to believe it. And it's really not necessary to believe it. It's just, we're looking at a larger picture. The big picture is deflation, okay? Not inflation. We're going to have inflation, but we're going to have deflation first. The dollar is telling you that. If you go to the dollar, this breakout in the dollar is also telling us that deflation is on the horizon. The old high was way back here, back when gold was at a low. Actually, the high here in the dollar was in 2001, not 1999. So gold bottomed out kind of early, and then later the dollar topped out, and you had this big rundown into essentially kind of the same area that gold topped, and then you've had this consolidation, and now you got the dollar breaking out again. So I think it's very conceivable that we're going to see the dollar up into this area, get some sort of pullback, and then make new highs above this high. And now it could take several years. I mean, let's just go back and look at gold, and look how long gold has been in this pullback. The high was in 2011. We're now in 2016. This is a 5-year pullback. So you could conceivably have, let's call it, kind of a 2-year bounce up into this area, and then like a 3 to 5 year down move. I mean, we could be talking about, another 6 or 8 years before gold comes down into this area. So this is telling us, this long pullback in gold is telling us that we're looking at deflation, not inflation. And we've talked about deflation before. How does that happen? In general, deflation is when there's a contraction in credit and money. So the way our system works is when you create credit, it creates money for the economy. But if there's a correction in credit, a contraction in credit, then what happens is money and credit disappear from the economy, and this causes a deflationary effect on our GDP. I mean, basically everything. Asset prices, jobs, everything under the sun. Let's go over to, I want to look at NinjaTrader and go to crude oil. This is the continuous contract in crude oil. You can see here, we've been trading. Let me make sure this is right. I'm always a little bit nervous about these NinjaTrader charts because sometimes I don't have the updated information for whatever reason. Yeah, so see, Thinkorswim is saying oil traded up to 32 and some change. And NinjaTrader is not saying that. Let me find the chart. It's saying that we closed at 31.74. So I don't know why NinjaTrader's off slightly, but it is. It could be because I'm on the continuous contract and not on the. Let's see if I have the. Yeah, I don't have the. Let's pull it up here and see. If I go to the February contract and pull it up, let's see if it still says 31.74. It might say, well, it actually says something lower. So I don't know. I'm not so sure about the NinjaTrader pricing on oil. Could be that we've got the March contract up now, and I just don't have it in my list of indices. So the bigger point I wanted to make on on crude oil, give it a second here to pull up the continuous contract again, is that we've got this, this kind of a 1, 2, 3. We got this third wave here. Of course, what comes after a third wave is the fourth wave, and we should see something into this mid-60 area. Somewhere around here, 62 to 65, something like that, and then roll back over to lower prices. And obviously, this is going to take some time. Oil's just got this monster pattern that we're dealing with, and it's in a contracted downtrend, i.e. deflation, just like gold, copper, other commodity type products. What else do we have here on NinjaTrader that we could look at? We could look at the DAX. Here's the DAX. DAX is at a decision point, and that's on a black STF, which means that's valid, which means the DAX could be wanting to make, well, not a new high, but at least a new pivot high. So we'll keep an eye out for that on the DAX. Let's see what else we have. Let's see if we got the British pound. Same kind of thing. The British pound pulled back to DP support. The next DP support is this previous pivot here, which is right in this area. So we'll continue to leave that on the chart and see how that plays out. Let's see what other charts I've got here. I've got the euro. That's the March contract on the euro. So notice we didn't make a new low here. Can I get this zigzag this way? And we'll probably get a zigzag this way, and then a zigzag this way, and then a fall down to a pivot off of this low, which is down around 0.9845. So we'll look for the euro to move down below this area, and it's in kind of a blowout sell-off. And then you'll see a pretty good bounce in the euro. Should see a pretty good bounce. All right, everybody, that's really about it for this week's Middle Class Investor. I want to thank everybody for coming in and viewing my videos. I do this simply because, it's just a place where people could come that really don't know that much about the markets and don't have a feel for how they move, and just want to make sure they protect themselves. And that was the reason I started making these videos, and it's the reason I'll continue to make them. And tell your friends and family. I just, my feeling is we're at a very unique time in history, and it's much more analogous to, this area back in here around the Great Depression, or another area that's very similar is in this 1970-75 area. You can see here we ran up, pulled back, ran up, pulled back, and you can see these. This really almost looks the same as what we've got going on in our markets now. You got this kind of a cone situation. Whoops. Well, can't seem to. There we go. So we kind of got this situation going on, and if you notice, this looks very similar to this situation where you've got these highs. I can't draw it. This right here, this bump, looks very similar to this same pattern here. And you can see that once it broke down, it actually made a lower low. So notice this low is lower, or this low is lower than this low, and when this low comes down, it'll actually be lower than this low and this low. And that's really just kind of what we want to keep an eye on. Make sure that we don't, take huge losses and come down to this area right here. There's no reason to lose 80% of your money. There's just absolutely no reason to do it. And that's the purpose of this video. And if you're telling friends and family about it, tell them that that's the purpose. So come on in here on YouTube at Middle Class Investor, and then on Twitter at Investor Class. All right, everybody. Thanks a lot for coming in this week. I will see you all next week. Take care, everybody. Bye-bye.